Welcome to the Cordier Commodity Report, where James Cordier breaks down what's really driving gold, silver, oil, and the global economy. We'll go beyond the noise to explain the cycles, data, and signals beyond major commodity moves. Hola, I'm Joe Pardavila, and this is James Cordier. Hello, James.
Good afternoon, Joe. How are you doing?
I'm excellent. And you've often said, James, the most dangerous place for an investor is inside the crowd. Why do so many people still follow the herd? And obviously, we're recording this in the middle of a little conflict going on in Iran. It's affecting prices in oil. But tell me about this idea of being part of the crowd, staying in the crowd, and following the herd.
Joe, I've been in the commodity space now going on like 3 decades, and people said, James, what's some of the experience that you could share with us to hopefully, help some of us who do some of their own investing in commodities. Primarily, the people that I know that are invested in this space invest through us, but there are a few that want to do it themselves, which I love that actually. And basically, not being part of the crowd, I think, is my best advice. Simply spoken, that when Venezuela was taken over, and I'm getting calls from friends and associates and colleagues saying, "My gosh, the price of oil is going to, go through the floor. It's going to go down because we're going to, accept 3 to 4 million extra barrels by taking over Venezuela." And the fact of the matter is, you need to know what the fundamentals are, and if you analyze them, you'll realize that Venezuela is just a decrepit oil producing nation right now. They used to produce 3.5 to 4 million barrels. Recently, they've been producing, 10% of that. And that's something that a person really should know. The entire crowd runs to, sell crude oil, sell gasoline because we just took over Venezuela. And the fact of the matter is, it wasn't help at all. Basically, all you're doing is taking oil workers out of the United States, sending them to South America, where they're not going to be producing oil for any time soon. And simply put, that's a perfect example of you don't want to be part of the crowd. You need to analyze the market. And generally speaking, when you're seeing news items or talking heads on some of the business stations, and they make just this amazing description of why the market's going to go down or up, and you can just hear the other people rooting them on, and you have to think to yourself, chances are he's wrong or she's wrong. And you think about why they're probably not accurate. And all of a sudden, you're grasping that idea. And once you start doing that, you're no longer in the crowd. And that's where you want to be.
It's funny, James. You mentioned that anecdote about how things didn't shake out in terms of the oil prices because what's going on in Venezuela, because of how much work it takes to get these things going. And we talk about seasonality all the time. And when I talk to folks in the oil industry, they always love when you hear politicians say, "Drill, baby, drill," but they always say, "But just so you know, we're not going to be able to start drilling right away. There's a lot of work that goes into it, and we're seeing that, like you mentioned, that in Venezuela." Tell me about this idea of how things don't always move how they're supposed to move, and or the way we want them to move.
Certainly, going down to Venezuela and getting it restored to producing 3.5 million barrels a day, that's going to take at least 3 to 4 years to
Wow.
accomplish that. Yeah. For the United States, for example, in the Permian Basin, you're looking at a year and a half to really pump up production here in the United States. We're at 13 and 2/3 million barrels a day, something like that. The likelihood of production in the United States of crude oil getting over 14 million barrels, it's a non-starter, really. A lot of the people in the Permian Basin don't want to flood the market with additional barrels. I think they feel that the equilibrium that we're looking at right now is kind of ideal for them, with oil trading above 60, um, oil trading below 80. That seems to be quite a sweet spot right now for energy producers in the United States. Drill, baby, drill, I think is it's a cliche. It's trying to get energy prices down, but there's a lot involved with, what creates the price of a gallon of gas when you go to pump at the end of the station.
So interesting. So what you're saying is, and I know we don't like to get political here, when you hear politicians say that and the energy markets hear that, Is it more of just like, okay, cool, this is going to be less regulations? It doesn't mean that we're going to be making more oil, because you kind of mentioned there, we don't want to make too much oil because then the price will drop. So it's almost like a paradox, right? That drill baby drill.
It's a rally cry, and it feels good because everyone likes low energy prices. Drill baby drill is not going to change the production here in the United States very much at all over the next year or two. But we do have something called natural gas, which we're producing at record paces. So the United States is now the largest producer of crude oil, the largest producer of natural gas. And one thing that this administration and some of the previous wanted to do is get us off the independence of Middle East oil, and we have done that. China relies on it, India relies on it, Japan relies on it, but the United States, that was something we wanted to accomplish, and we've got that done.
Excellent. All right. So if you're watching this and we're going to be running up against a midterm and you hear that phrase drill baby drill, just remember this episode and what James told you about it to give you further context. So thank you very much for that, James. And I want to get back to this, the contrarian thinking that you've sort of embraced over your career. There's that famous Business Channel commercial where young brokers run like sheep toward a cliff. When you watch the markets today, do you still see investors doing exactly that? I mean, it was a joke, but do you still actually see it in practice today?
Joe, you absolutely do. My favorite commercial ever on the planet was on the business stations a few years back. And there's this middle-aged gentleman, and he's standing in front of just the most amazing mansion that you've ever seen. It's like Laguna Beach in California. Here are the rocks and the cliff below his home. And all of a sudden, he's got this smirk on his face. And he's going like this, and he's like looking in the distance. And across where he's standing is yet another cliff. And there's like 80 young brokers with brand new blue jackets heading over the cliff. And that's not the group you want to be in. You want to be that middle-aged gentleman over here watching the sheep, if you will, because that's what the interpretation was of that commercial. And commodity trading is so headline driven. And what it does is it gets people moving in a certain direction, whether they're selling because it's going down or they're buying because it's going up. This happens all the time. And if you just sit back for just a moment and say, wait a minute, this news and these fundamentals are already priced in the market, and these guys are getting there late. And this guy is just like taking tickets from all these guys as they jump off the cliff. You want to be contrarian. You want to spend time analyzing different fundamentals. And if you do that, you'll be able to be the guy on the other side of the cliff in front of the mansion more times than not.
And, obviously you're not a psychologist, but you do know the psychological aspects of trading. And, I think for a lot of people, when you hear like following the crowd, it's almost like a put down to the people, like you're not that bright because maybe you're quote unquote dumb for following the crowd. But and you talk about, and you see it all the time. It's smart people following the crowd. Why do smart people, and you deal with them almost on a daily basis, James? Why do they still chase the same trade, even though, for lack of a better phrase, they should know better?
It just makes sense to. We've got this skirmish going on, this war going on in Iran right now. The Strait of Hormuz is closed. China receives over half of their oil through this area. Clearly, you buy oil. Clearly, it's going to go higher. It's all priced in our opinion. About 3 days ago, when oil hit $120 a barrel, that was likely the high. And how we come to that conclusion is because if you break down the fundamentals, China has 1.4 billion barrels in storage right now. There are approximately 750 million barrels of oil floating around the oceans, waiting for buyers to simply call up and say, hey, we'll take that oil. That's what's taken place recently. It's such a knee-jerk reaction to follow the headlines and invest and trade that way. Yes, intelligent investors might do that. It's like, man, I want to get in on this. I've seen the price of gas go up and down, and it always made sense to me, and I never did it. Well, here's my chance to get in because of the Iranian war. And the fact of the matter is, if this gets settled, chances are Iran is going to be producing more oil than they have in years and putting it out on the open market. And that is the opposite of the reason why people are buying oil right now. A year or two from now, oil might be back down to 55 and 60. I would not be buying it here at 90.
Wow. All right. So James, you know I'm good for one silly question every episode. So here's my silly question this week. And I know you love these, James. You've told me how much you love this. No, you haven't. Does oil go bad? Because you talked about how China's stocking up. We all hear these stories about the Straits of Hormuz, where like they're just backed up and they're just sitting on ships. People are stockpiling it. Does crude oil go bad? Is it okay that it's just floating out there, or it's sitting in a facility somewhere?
It can float out there for years. And
Okay.
some of the oil that's sitting out there has been floating for years. Joe, when I come to the studio every Monday, I long for your silly question, but that one wasn't silly at all. That's a real question.
Okay. And so tell me about these effects of the fact that, okay, so they're floating out there. You talk about they've been there for years. How does that work in terms of like how they continue to produce? Do companies and countries get to the point like we got way too much out there, let's stop making it, or is it just is this thing just just always pumping?
Joe, let's analyze the fundamentals. A third of that oil is Russian oil. Okay, they can't sell it except on the black market to China and India. The other third of the oil is Iranian oil. They have sanctions against their oil. That's why it's just sitting there. But all it requires is a phone call from the right individual on Pennsylvania Avenue, and they get to sell the oil. And that's what just took place this past week. And that's why we think chances are the price of oil likely topped out here just recently. Is it going to fall out of bed and go back down to $50? It's not going to do that. Certainly not anytime soon. But as far as like chasing it at 100 and 120, because so many people come on TV and say it's going to 150 and $200, the fundamentals don't justify that, and they won't support the prices going up to any type of levels like that.
All right, so James, when you take the opposite side of the crowd, this contrarian mindset, what signals tell you the herd is wrong? Because we've kind of come at this, James, that the herd is always wrong, but obviously sometimes the herd is right. What are some of the signals that tell you that the herd's wrong?
What happened in Iran, I think, recently is a perfect example of the herd's probably going to be wrong. Uh, Generally speaking, when I first broke into this business, it wasn't raining in the Midwest. And in the Midwest was the largest soybean and corn producers in the world. And every day it didn't rain and everyone was buying. And the next day everyone was buying and it wasn't raining. Okay. In this instance, the herd is absolutely right. We had one of the worst droughts in 1983 and 1988 that anyone can recall. And the price just went straight up and the herd was right. And we had a very small corn and soybean crop in the Midwest. And that was one of the instances when the herd can jump on. It's extremely dry in Illinois, Indiana, Iowa, and everyone got to take that ride, including myself and my clients. It was really good.
Okay, great. So just back to the Iran conflict, when most investors you saw run to precious metals because of these crazy prices, and you said it's leveling off, but you always see this sort of like knee-jerk reaction of like, okay, this thing is too high, I'm going to go buy this, go and get this thing. Is that the right move in this context of like, okay, cool, I don't want to get in this rat race of oil and the spiking prices. I'm going to try and go get some gold or silver or copper or what have you. What do you think about that sort of take?
Well, interestingly, all the gold commercials that you see on TV, they're showing wars going on and the marching going on in North Korea. You know how they march like that. It's so interesting to watch. And the missiles going off in the commercial. And that's when you buy gold and silver. And lo and behold, here we have that going on in all actuality. And the price of gold and silver have gone down the last 2 weeks in a row.
Why is that?
Everyone ran to buy the US dollar. And commodities are all priced in dollars, especially precious metals. And as the dollar strengthened, the price of gold and silver fell down. And they've gone down practically 2 weeks in a row. Interestingly, Joe, to ponder on this question, as the Iranian situation hopefully slows down and hopefully gets taken care of, and the Iranian nation and the people there are in a better place, and they get to pump oil like they used to do, hopefully you're going to see now the price of the US dollar fall. And now we're looking at gold and silver then going up, contrary to what you would think. Oh, the war is over. I don't want to buy any gold and silver. Now's the time to get in. You're going to see a weaker US dollar. Gold and silver's priced in dollars. And we think that shopping around at these much lower prices that gold and silver are at now might turn out to be a good idea here in the second quarter of the year.
Is that, we talked about the psychological piece. Is that pretty standard in your world, that where if there is some sort of global conflict and there's an issue with oil, like people automatically like, okay, cool, I'm gonna go do some metals. Is there some almost like a yin and yang to, of like, when it gets crazy over here, I'm gonna go invest over here?
Yes, that's exactly what happens. And that's exactly what we're talking about. And the fundamentals often don't justify it, but the headlines do. And 2 weeks later, it's like, oh shit, the headlines were already priced in.
Wow. What signs tell you a commodity already topped even while the headlines still sound bullish?
I got one for you, Joe. This past year, the price of coffee is rallying and Starbucks is raising their prices and people are, upset with how much their morning Joe costs them each day. And certainly then you start getting Folgers raising the price of coffee, Nestle's, Starbucks and such. People say, well, I'm going to buy coffee. I want to invest in coffee. The price is going up. They're raising the prices. The fundamentals that created that drive had taken place 6 months prior to that. And it just so happens, as the price was reaching all-time record highs, what everyone was afraid of was a second dry spell in southeastern Brazil, where the vast majority of coffee is produced in the world. And it started raining every single day in a row as the herd is rushing in to buy coffee. We just had some of the best precipitation we've ever seen since I've been trading coffee for decades now. And Brazil, the largest producer of Arabica coffee in the world, is now going to make the largest crop in history this coming year. And that's a perfect example of not rushing in because you hear that the price of this is going up or that's going up. Coffee prices could likely get cut in half from where they were. They reached over $4 a pound. We see them later on this year perhaps being around $2 a pound. Just got to watch the fundamentals. And if you're able and willing to do that, you can stay out of and avoid being part of the herd.
All right, so it's warming up. You've got the new Florida tan. You're feeling good. It's planting season. Why should investors pay attention to crops when thinking about commodities?
Joe, we've talked about precious metals and energies on several of our podcasts, and spring is planting season. You can't eat silver, you can't eat gold, and you can't eat crude oil, but corn, soybeans, and wheat feed the entire world. And Brazil and the United States are the largest producers of grains and protein, such as soybeans. And the months of April, May, and June are extremely critical to feeding the world. If we have an extreme drought or we have too much rain or the planting season doesn't take place correctly, you're looking at perhaps a 5 or 10 or 15% reduction in the supply of corn, soybeans, and wheat. And that's a big deal. These three commodities do feed the population globally. And the next 60 to 90 days are going to be very important to make sure that we can do that at a very economic price for all the importing nations.
Now, you talked about the weather. What factors determine whether a crop becomes the next big commodity story? I mean, you just talk about coffee. I mean, is it always weather, geopolitics, demand? What is it when it comes to the crop side about what's going to drive and become the big story, that the next oil of food or gold of food? Like, what do you usually key on that drives that price?
Joe, you're exactly right. A lot of people that talk to me about trading commodities, they say, well, you probably watch the weather a lot. And that's true. I'm constantly watching the weather. If it's planting season in the Midwest, we're watching Illinois, Indiana, Iowa. They're on my phone. They're locked in. Cocoa prices and coffee prices when it's flowering season in Brazil. I've got 3 different locations in Brazil locked in on my phone for watching the weather. And it's all about the weather. The U.S. farmer is the best farmer and producer in the world. and they've learned how to avoid a drought, and they've been able to culminate soybean genes, genetically speaking. And what it does is, if it's a little bit too dry, the bean's ready for it. Or if it's a little bit too wet and planting season doesn't go exactly the way they wanted it to, uh, the planting in the soybeans and corn can overcome that. So the U.S. farmer has really become a little bit too good for his own good. That keeps prices relatively low, but there are several things that can go wrong with a perfect season, like we had last year, and like Brazil had last year raising soybeans. So we will be watching. There's 100 things that can go wrong weather-wise with some of these markets, and we're going to watch them very closely.
So, from our conversations, James, we talk a lot about oil, obviously, because of what's going on, but it's a lot of metals, silver, gold. And I sometimes feel like the agro world they're sort of like the redheaded stepchild of the commodities world. Why do these commodities often get ignored until the prices suddenly spike, or you have like these crazy weather patterns? Like you said, last year was pretty solid, so there wasn't any kind of like volatility there. But is it always because of the fact that like everything's pretty steady until there is a weather event?
Joe, that's a really good question. If you think about it, a gold coin this big is worth $5,000. A silver coin this big is worth $90, and a bushel of corn this big is worth $4. And that is why the gold and silver and platinum are the sexy markets, and corn is not, until it doubles in price. And it's, oh my gosh, I should have bought the corn. Got a huge drought going on in Illinois right now. So that big bushel of corn or soybeans is not sexy, not compared to the shiny shekels as people talk about. But the weather does make the news, and if it gets extremely dry this fall and prior, we're going to have a lot of people following corn and soybeans. Maybe take a back seat to some of the precious metals, which hasn't taken place in quite some time, but maybe it's due to do just that.
In terms of that price point, by the way, great example, great like space work. I feel like you signed up for an improv class. That was really good, James. But like, does that like sort of inspire people? Like, hey, listen, the fact that that bushel of corn is going to cost $7 or whatever, I'd rather deal with gold and silver. Do you see people in your world that either just strictly are either spread to all commodities, or just say like, I just like that big shiny gold and silver pieces. I don't want to deal with that. Tell me what's the benefit of, either being broadly speaking or more specific in what commodities you're dealing with?
We want to trade a basket of commodities. We want to be in grains, softs, which are coffee, cocoa, sugar, orange juice. We want to be in energy like crude oil and natural gas. We want to be in precious metals. And what we want to do is follow these 10 or 12 markets. Not that there's opportunities practically ever in all 12 at one time, but that way you try and not miss anything. If you're following the cocoa market, let's say you haven't traded cocoa in 3 years, and all of a sudden, you have the perfect setup to be either long or short that market. So you want to keep your eye on the four sectors, but don't ever think that you have to, become an expert at these and have them all on at one time. Usually, following about 12 markets, there's opportunities in 4 or 5 at any given time. So we try and focus on all of them, but certainly don't trade all of them all the time.
Excellent. All right, cool. And you've used the word fair and fair value a bunch of times. And, for someone like me, like I don't know what the average, cocoa bean goes for, but like, how do you determine what fair value really is? I mean, you've got the receipts, 30 years of doing this, so you kind of have like a general idea of what fair is, but obviously fair today is fair from 20 years ago is completely different. So how do you judge what is fair value?
First of all, there's an auction that takes place every day with, hundreds of millions of dollars betting on whether something's too high or too low. And at the end of the day, where does it close at? Fair value.
Hmm.
It's an auction amongst millionaires and billionaires and banks and end users and Exxon and Starbucks. And at the end of the day, it's at fair value. So when someone says, oh my gosh, this is going to the moon or it's going to zero, actually, it's not. Actually, at the end of the day, when the bell rings at 2:30, it's fairly priced. And that's the way we try and look at it.
So essentially, commodities are fairly the median, right? And then when there's geopolitical or weather, that's where you see the spike. So it's steady because the market corrects itself, like you said. But when there's these external factors, that's when things get out of whack.
I would describe that exactly like that, Joe. I think you nailed it. Yes.
Wow, cool. Thank you very much. That was awesome. And thank you for making me feel smart for there for a second. So, all right. So, what fundamentals do you watch first when evaluating a commodity market? So, since we talk about like everyone kind of knows in your industry what's fair value, what it looks like because it is correcting itself. What are you looking at? What do you watch first when evaluating the commodity market?
Over the last 5 years, in any given market, is there a production deficit or a production surplus? Okay, so production surplus means that the world produced more wheat than it consumed over the last 5 years. That's a bear market. The world has produced 5 years straight less orange juice than it's consuming. That's a bull market. 5 years is a really good rule of thumb. If production deficits and surpluses are going back and forth one year after the other, that's a neutral market. If cocoa production has fallen off and it has a production deficit 5 years in a row, it's probably going higher. And that's exactly what we saw cocoa do this past year. Went to all-time record highs. And high prices cure high prices. And son of a gun, if they didn't figure it out, and now we have a surplus coming the next probably 2 or 3 years in cocoa, and now the price got cut in half. Just follow the fundamentals, and not that you can have a winning trade or winning investment every time you do that, but when there's significant sideways motion, the market's going to probably go sideways because if it's got neutral production deficits and surpluses. But when you have 5 or 6 in a row, chances are that's a trend you want to get on.
All right, great. So let's wrap up with a couple things. First, we talked about planting season. Is there any crop market right now that looks the most interesting heading into this warming heading season as people start to plant? Anything come to mind when it comes to something that might be interesting to you?
Soybean planting in the United States is going to be down slightly this year. And I think what they're doing is farmers here in the United States are perhaps switching to other row crops. Brazil has just been a thorn in the side of U.S. farmers, producing record crop year after year after year. They did it again this year. And the U.S. farmer, I think, would do himself or herself a great favor in planting a little bit fewer soybeans this year, get the production not so high here and in Brazil. So we're going to watch soybean plantings this year. We expect them to be lower. And I think that is going to help the farmer come November when it's harvest time.
Excellent. And so the theme of this conversation has been about being a contrarian. So let's wrap up with this. How do you become the person watching the crowd run toward the cliff instead of running with them?
Just analyzing the fundamentals of the market. Some of the things that we spoke about the last 30 minutes or so, Joe, keeps you being that middle-aged, wiser guy on the right side of the cliff and not part of the 80 suits that are running for it. Just analyzing the market. There's something called the Commodity Research Bureau book. Anywhere from asphalt to zinc and everything in between, you can become an expert at if you're willing to open up that really large book and turn each page and read it. It's the Bible. I have that on my desk and in my office the last 22 years in a row. That's where I would get started if someone wants to become an expert trading commodities.
I love the randomness of your commodities industry with the fact that you have asphalt and zinc. Can you give me another, as we sign off, just to have some fun? What's another random commodity that most people wouldn't even know about, or it's like not actively traded? Is there one out there that people be like, people trade blank, and I would be like, huh? What's another random commodity you could throw my way as we sign off?
In 1983, which is probably well before a lot of our viewers, but in 1983, there was something called Trading Places, the movie with Eddie Murphy, and they traded orange juice. And I traded orange juice several times in my career. Sometimes traded it well, sometimes not so much. But yeah, you can speculate on the price of orange juice and, hedge your mimosas in the morning on Sundays. I'm not sure that's hedging. And we're, of course, are speculators. But orange juice can be a really profitable bet if you're a little bit ahead of the crowd.
Excellent. You can find out more at CordierCommoditiesReport.com. He is James Cordier. James, thanks so much for the time. I will see you next time.
Thank you, Joe.